Your board will kill your best investment next quarter unless you do this. I'm Rich Smith, Chief Marketing Officer, founder, growth advisor, and host of the Revenue Science podcast. I've spent 3 decades applying the science of human behavior to marketing and revenue strategy. Everything I share here is grounded in real-world results and real science. No fluff, no jargon, just what actually works. It's late February 2026. You just survived the January board meeting. The deck looked great. Pipeline pointed up and to the right. Everyone nodded at your 18-month retention strategy, and then someone said it. We just need to hit Q1. We can reinvest in the long game later. Well, later almost never comes. I've spent more than 30 years watching this exact pattern destroy companies. Doesn't matter if it's a startup racing to Series B, a mid-market firm doing hundreds of millions in revenue, or a global Fortune 500 company. The size changes, the pattern doesn't. Acquisition gets funded, retention gets optimized, customer experience becomes a cost center, churn quietly rises, and revenue turns into a treadmill where you work 70-hour weeks just to stay in place while your competitors who protected their compounding engine pull ahead. Here's what most CEOs get wrong. They think this is a board problem. My board is short-sighted. They don't understand long-term value. I need to communicate better. It's not a board problem. It's a human brain problem. And unless you understand the neuroscience behind why smart boards make decisions they know destroy value, your best long-term investments will die by March, approved in January, defunded by spring. By the end of this video, you'll understand exactly why your board approved your strategy in January and will quietly kill it next quarter. More importantly, you'll have a 5-part framework to design around their brain's hardwiring instead of fighting it. This isn't speculation. Landmark research by Graham, Harvey, and Rajapal, published in the Journal of Accounting and Economics, found that executives openly admitted they would take actions that harm long-term value just to meet near-term earnings expectations, because markets punish misses and reward predictability. If your board is oriented around analyst expectations, financing milestones, or stock price optics, they're swimming in exactly this water. Section 1, the neuroscience behind why boards betray their own long-term commitments. Your board isn't lying to you in January. Their brain is lying to them by March. Behavioral scientists call it temporal discounting, our hardwired tendency to treat future value as dramatically less valuable than value today. In the boardroom, this shows up as quarterly thinking, prioritizing immediate bookings, margin headline metrics over retention, brand, customer success, and product investments that compound over time. But here's what makes this particularly insidious. Research on hyperbolic discounting shows we apply an especially steep penalty to anything that feels not now, then flatten out over longer horizons. This creates time and consistent preferences. Your board can genuinely endorse your 18-month strategy in January, then experience a completely different emotional calculus when Q1 results come in and suddenly missing the quarter feels catastrophic. Frederick, Lowenstein, and O'Donoghue documented this in their review of time discounting research published in the Journal of Economic Literature. They found spectacular variation in estimated discount rates, with many results in the double digits, far above what rational economic models would predict. Translation: when your board treats an 18-month payback as basically never, while treating a same quarter revenue bump as obviously valuable, they're functionally applying a 40% plus hurdle rate to your best long-term investments. Now layer in construal level theory. Psychological distance makes us think abstractly about the future. And abstract value will build brand equity, will improve retention, rarely beats concrete near-term risk inside a tense boardroom conversation. And loss aversion on top. Kahneman and Tversky's prospect theory research showed that losses feel roughly twice as painful as equivalent gains feel good. So missing the quarter doesn't just feel bad, it feels catastrophic, even when the NPV model says the long-term bet is obviously right. I watched this play out at a SaaS company, shifting from one-time implementation fees to a land and expand model. 6 months in, bookings looked flat, board panicked, pushed the CEO to go back to what was working. CEO caved. 2 years later, their competitor who made the same shift and stayed the course had 40% higher valuation. Their net revenue retention was 125% and predictable. The original company, still on the revenue treadmill, burning out their sales team to hit the same number every quarter. Here's what this means for you. You cannot eliminate present bias from the boardroom. But once you understand this is brain architecture, not board personality, you stop trying to persuade harder and start designing systems that work with how human decision making actually functions under pressure. Section 2, the Adobe case, what it actually costs to choose long-term LTV over near-term optics. Adobe's move to Creative Cloud is held up as the gold standard. Subscription model worth billions, recurring revenue, predictable growth. What nobody talks about is the revenue dip they had to absorb and how close that came to not happening. Adobe's transition from packaged software to Creative Cloud subscriptions required absorbing a meaningful revenue trough before the compounding benefits of recurring, predictable revenue became visible. McKinsey documented this transformation. It played out over years, not quarters. Adobe's stock eventually reflected the model's strength, but only after the company and its board stayed the course through the dip. Most boards don't have that conviction because they experience the dip as loss and the future payoff as abstract possibility. That's temporal discounting and loss aversion working in real time. Here's the boardroom lesson. Long-term transformations almost always look worse before they look better. If your board is not prepared for the dip, if you haven't pre-framed it, built proof points into it, and created governance structures that prevent re-litigation, they will force course corrections that sabotage the transformation in mid-flight. I've seen this pattern repeat dozens of times. CEO gets approval for a strategic shift. 3 quarters in, results look flat or down. Board gets nervous. Someone says, maybe we moved too fast. Another board member says, let's pause and reassess. And the entire transformation dies. Not because it was wrong, because the board's brain couldn't tolerate the psychological distance between right now feels scary and 18 months from now we're positioned to win. The companies that survive this aren't smarter. They're better at designing around the cognitive trap. Section 3, Amazon system, long-term orientation is not a personality trait, it's a governance architecture. Jeff Bezos didn't ask Amazon's board to be patient. He built a system that made impatience expensive. Amazon's 1997 shareholder letter is famous, but most people read it as inspiration. That's the wrong lesson. Here's what Bezos actually wrote. We will make bold rather than timid investment decisions where we see a sufficient probability of gaining market leadership advantages. Some of these investments will pay off, others will not, but we have secured a place in the long-term interests of shareholders. That wasn't a one-time speech. It became a repeatable governance commitment that trained investors and directors how to evaluate the company. This is the part most CEOs miss. Long-term orientation is not a leadership personality trait. It is a system. It's metrics, narratives, decision logs, and board pack architecture that has to be actively maintained, reinforced, and protected from erosion. Amazon reported metrics that measured long-term value creation, customer lifetime value proxies, repeat purchase rates, market share in strategic categories, and subordinated quarterly GAAP earnings into the narrative hierarchy. That meant that when the board looked at the dashboard, the future was visible and measurable, not abstract. Your board doesn't resist long-term thinking because they're dumb. They resist it because they can't see it. Construal level theory tells us psychological distance makes the future abstract, and abstract loses to concrete risk every single time. The solution isn't better persuasion, it's better instrumentation. Convert LTV into near-term control metrics that update inside the quarter. activation milestones, time to first value, expansion pipeline from existing accounts, cohort retention curve trends, customer health score movement. When your board can see the leading indicators of future value on page 3 of the deck, not buried on page 47, they stop experiencing your long-term strategy as trust me and start experiencing it as here's what's working. That's how Amazon did it. Not charisma, systems. Section 4, the reverse countdown technique, how to make 18 months feel like right now. Your board isn't buying the entire future. They're buying the next proof point. Here's the tactical move that changes everything. The reverse countdown technique. Instead of presenting 18-month payback as a date on a slide, start at month 18. Describe in concrete operational detail what the business looks like with churn down and expansion up. Then walk backward. Month 12, month 9, month 6, month 3. At each step, define what will be true operationally, not just financially. Why this works? It reduces psychological distance. Research by Peter and Buchel, published in Neuron, showed that mentally stimulating concrete future events reduces delay discounting. When people can vividly imagine the future, they value it more. That's episodic future thinking in action. When your board can see the operational milestones, by month 6, customer health scores will show 15% improvement in red zone accounts. By month 9, expansion pipeline from existing accounts hits 2.3 million. The future stops feeling abstract. It becomes a series of endorsable near-term wins. Now pair this with 90-day proof points. Break every 18-month investment into 3 90-day chapters with explicit, measurable deliverables. Your board isn't approving a 2-year bet, they're approving chapter 1. This architecture respects present bias while still building compounding value. Real example, I worked with a CEO who wanted to invest in customer success infrastructure, dedicated CSMs, health scoring, proactive outreach. Board kept saying, let's see how Q2 goes first. We reframed it. In 90 days, we'll have health scores deployed and visibility into the top 20% of at-risk accounts. In 180 days, we'll have intervention playbooks and a measurable reduction in red zone churn. In 270 days, net revenue retention moves from 98% to 105%. Approved in one meeting. Why? Because they could see the next 90 days, and that made the entire investment feel less risky. Your board's brain isn't wired to evaluate 18-month bets. It's wired to avoid immediate loss and pursue immediate gain. Give them a structure that lets them say yes to chapter 1 without having to emotionally commit to the entire story up front. That's how you protect long-term value without getting defunded by March. Section 5. Lead with risk, not upside, and build governance that prevents re-litigation. Long-term initiatives die when framed as growth opportunities. They survive when framed as risk management. Here's the reframe that leverages loss aversion instead of fighting it. Stop selling long-term investments as growth opportunities. Start positioning them as risk management. Retention isn't a nice to have. It's your insurance policy against acquisition cost inflation. Churn isn't a lagging indicator. It's a compounding liability that quietly destroys the unit economics that made your business fundable in the first place. When you frame customer success investment as what prevents us from losing the revenue we already paid to acquire, your board's brain processes it differently. Loss aversion kicks in on your side for once. Build governance that keeps long-term investments from being relitigated every 90 days. Include one LTV headline metric, net revenue retention, gross revenue retention, cohort retention, and 2 leading indicators in every board pack, not buried on page 47, on page 3, right after revenue and bookings. Maintain a decision log. What was approved? What is being measured? What would cause you to stop? This creates a governance loop that makes temporal discounting visible and harder to act on unexamined. When someone says, maybe we should pause the CS investment, you pull out the log. We approved this in January with these success criteria. Here's where we are. Has something changed, or are we relitigating? That question forces the conversation out of reactive emotion and into explicit decision making. Paul Pullman became known for explicitly challenging short-term shareholder primacy during his tenure as Unilever's CEO. He told investors who weren't aligned with long-term value creation to look elsewhere. This wasn't arrogance. It was a recognition that you cannot simply persuade everyone to think long-term. Sometimes alignment requires selection, not persuasion. If you are constantly fighting your board's time horizon, it may be a mismatch problem, not a messaging problem. But before you conclude that, make sure you've built the systems, the metrics, the governance, the 90-day proof points, the decision log. Because most of the time, the mismatch isn't philosophical, it's architectural. Your board isn't opposed to long-term value. Their brain just can't hold it steady in the presence of near-term fear. Build the systems that let them see the future, and they'll stop killing your best investments by March. If you're a CEO or founder managing a board that keeps pulling you toward the quarter at the expense of the compounding engine, I work with a small number of clients on exactly this, building the systems, language, and governance structures that protect long-term value without getting you fired in March. If you want to explore what that looks like, links are in the description. You now understand why your board isn't short-sighted, they're human. Temporal discounting, hyperbolic discounting, loss aversion, and construal level theory create a cognitive force field around every boardroom table. 18 months from now feels like never. Missing this quarter feels catastrophic. You've seen what it actually takes to produce long-term value. Adobe absorbed a revenue dip and stayed the course. Amazon built a governance system that made long-term orientation repeatable, not personality dependent. Unilever filtered for time horizon alignment instead of trying to persuade everyone. And now you have the framework. Lead with risk, not with upside. Convert LTV into near-term control metrics. Break long-term bets into 90-day proof points. Use the reverse countdown technique to make the future vivid and concrete. Build governance that prevents re-litigation. But here's what we didn't cover. How to actually sell this framework to a board that's already skeptical, already burned by past long-term bets that didn't pay off, already under pressure from investors or analysts to hit the quarter. That requires a different kind of conversation and a specific narrative that earns you the room to build compounding value without getting replaced. For more on growing your business, please subscribe to this channel and connect with me at richmsmith.com. Link is on the screen now.